Hi everyone, this is the first video dedicated to documentation so you can enjoy hedge accounting. This video is about designation memo or designation document at the high level. I will try not to write a lot at the board, but I will write a couple of concepts here so for you to better understand why is this important. And before we jump in, I want to state that everything that is written in accounting standards, it's important. It was thought by someone else repeatedly many times and delivered to you into the form of the document. Read it, pay attention to every phrase. It's written for some reason. I will deconstruct it into my video just to show where it comes from. And it usually comes from real situation with real business that tried to reflect something in accounting, in their bookkeeping entries, and it failed. And when it failed, it wrote the regulator body, or auditor wrote to regulation, to the body that regulates the activity of the company and accounting standards, and the standards were amended. So it's really important to know that it condensed base of knowledge, and it's important. Okay, we started with the posting itself. It's simple 3-4 stage process. I intentionally started with this one just to show that the posting itself, it's simple, straightforward, and you don't need to outsource it and pay a lot of money for it, either to consultants, either to your broker in terms of forward points. Okay, but let's recap a bit on the entry. What is it about? Time zero. If we speak about forward contract, you are agreeing on something that will happen in the future. And at the point zero, you don't have to pay anything. You are not paying USD, you are not paying other currency to receive other, because it will happen in the future. So what should be your accounting entry in that case? Time zero. It's nothing. Accounting entry, you don't need to do anything here. Why? Because it's kind of approximation, but remember in my previous videos I've mentioned how to close the contract. So you are purchasing the contract at some spot rate and forward points. It comprises of two components, spot rate and forward points. And you might close that contract, but to close that contract you should buy the contract with opposite direction. For example, you had here the contract Euro USD. To close it, you have to buy offsetting forward contract with the same maturity date for the USD Euro. And in accounting we don't do anything here because we assume that the bid-ask spread doesn't exist and you can buy offsetting contract at exactly the same spot rate. And the forward rates are not that fluctuating during the daily session, so we can ignore it. But we assume here bid-ask spread doesn't exist. Okay, what do you do at time 1. Your forward rate is fixed, but your spot rate has moved somewhere, either in your favor, either not in your favor. That means at time 1 you will have different forward rate for the same value date as you have here. And that means to close the contract, to buy the offsetting forward contract, you will have to pay different price, and that's where you will have your asset or liability. You can watch my previous video for more details, but here just an accounting entry. So time 1 you have debit hedge asset and credit other comprehensive income. Other comprehensive income is also a part of balance sheet, so it doesn't affect your profit and loss statement, and that's the beauty. It's available to you only if you have proper documentation in place, and if you designated your derivative, your forward contract, at the inception as a hedge. Hedge is not granted. Hedge is something you have to prove. You have to deserve, I would say, kind of deserve. But this is the reality. You have to document it properly to apply for hedge accounting. Okay, just for the completeness, I will write here, or it might be, or it might be debit other comprehensive income, credit hedge liability. It's not granted if you will have asset or liability. It depends on market conditions. The point here is to have it here or here, especially for the debit. Otherwise, if you don't qualify for hedge accounting, you will have to book the second leg of the entry into profit and loss statement. To avoid it, you should prepare your documents properly. Next talking point. Yeah, that's a good one. What is required? What is required to qualify? I will leave it as is for now, as the picture. But what basically required? You have to have the hedging strategy. This is your starting point. This is what agreed by management, by different bodies within the company. It might be treasury committee, it might be board of directors, it might be any other org or structure within the company. But it should be some kind of written document that states what you do and what you don't do. For example, it's usually written in hedging strategy that company does not speculate with derivatives. That means it only uses derivative instruments for the purpose of hedging. And what tenors to use, what instruments to use, what counterparties to use, what's the process for approval, what is accounting policy, all these high-level directions are written in hedging strategy. So hedging strategy is the first one. It's starting point. You should sit together with your management and agree on the approach, because this is starting point. The next one, once you agree on approach, you have to create accounting policy. And accounting policy is either in accordance with ASC 815 or IFRS 9. I prefer the following format for the accounting policy is when you write the point from the standard and company application as the second column. So it's 3 columns. First is a number, second is accounting standard statement, and the third one is company application. Because for many cases, like standard is comprehensive. It covers all situations. You don't need it. So you state this point, and if you're using only forward contracts, you are stating that only this is applicable for me, for my company, and that's how I treat situations like this. Okay, that's also a big topic. We will discuss it later on. And the third one, very important, is designation memo. This document should be prepared at about the trading date. There are here and there some differences in requirement between IFRS and US GAAP, but to be on a safe page, and it's proper approach, by the way, you have to prepare it on the date of trade or before it or slightly after it, because it just makes sense. How can you do your hedging if it's not written, if you don't know what you are doing? Okay, let's briefly discuss what's normally should be a part of designation memo and dedicate separate videos to deep dive into details. First of all, trade details. You should state what, like these technical details, like what is the trading entity. Sometimes it's not obvious. It might be your parent company or it might be one of the subsidiaries. Internal ID, that's I found very helpful to create your own numeration within the company for all the contracts you have and to stick to it. Because otherwise, if you are hedging a lot, you will end up with a mess in your documentation, in your spreadsheets, in your delivery reports. Spot rate source, forward points, all in rate. That's kind of in not rigid format, but you have to show that that you know your trading details, that you know what is your request to your broker. That's the best way how to think about it. Like, check what you're gonna write to your broker and put it into your designation memo. The same for transaction details. It's all from your order to the broker. It's buy amount, sell amount, value date, broker, and method of trade. And you can add some comments here. And for comments, I mean strategy name, purpose of hedge, exposure, nature of risk, definition of the trigger. That's all separate topic. You have to state when you put this number, because it will eventually go to profit and loss statement. But you're postponing it for a while until your actual transaction. So hedging is to have predictability, is to have predetermined outcome. You have underlying transaction that you're hedging. And at the day that transaction that will happen, the rate, if you're speaking about forward points, the rate will be different and you will have something unexpected in your functional currency. That's why you hedged. And you will have opposite direction effect from your forward contract, from your hedging. And the trigger here is expiration, so the period then your actual transaction is happening. If everything's in order from documentation perspective and from the substance, then your trigger is then your event occurred. And if you're hedging OPEX, when your OPEX occurred, you are moving your other comprehensive income effect into profit and loss statement, and in profit and loss statement you will have predetermined effects. Okay, that's a trigger, but the trigger might be different. Then, okay, let's move forward and we discuss later. Another point, probability of forecasted transaction. You have to show that your transaction is really probable to occur. To show it, you're discussing frequency of similar transactions, financial and operational ability to carry the transaction, commitment of resources, extent of loss if transaction doesn't occur, and likelihood that transaction with different characteristics can cover the same purpose, can help you to achieve the same purpose. And then some accounting stuff. You should also state what is the initial test of effectiveness. That's a big topic. That's going to be a separate discussion. Effectiveness assessment. It's tricky, and I will show how to make it simple for the simple cases. Don't try to overcomplicate it. Go read the standard, use applicable case, and sometimes it's just as simple as critical terms match, where you don't need to run regression analysis or dollar offset test. Subsequent prospective and retrospective effectiveness assessment. You also documented it in designation memo for the sake of documenting what type of effectiveness assessment you use for these particular hedges, because you might use different approach for different contracts depending on your policy, circumstances, and strategy. When writing, what will happen if effectiveness test is failed, and you're writing what's the financial statement impact and the tax treatment, and that's it. So basically, designation memo is a short combination of what you already have. You have your accounting policy. You're writing shortly what part of accounting policy you are using for that particular hedge. You have your strategy. You are showing in designation memo that you are complying with this strategy, the transaction is probable, and that this indeed in nature is hedging activity, not speculation. And you are listing all of your contracts that you do at designation date. Okay, that's a high level overview. Designation memo might differ from company to company. My preference is, from one hand, to have it comprehensive, but keep it simple. Comprehensive from the perspective that you have all the points stated, nothing left behind. And that's more for you than for auditors. It's for you to have the checklist. But from other hand, do not overcomplicate, then it's not required. And especially for effectiveness test. Okay, thanks a lot. See you soon. Bye.